Thank you very much, Tom, for the invitation. I realize we are half an hour before the departure, so I'll try to be brief.
So you're 25 minutes.
At the same time, I'll try to make it less of a lecture, but more of an interaction. So there is a little bit of fun at the end. The topics for the discussion would be, actually the title of my presentation is not actually the Slovakian perspective, but I put it EU taxation and tax avoidance, because I find it's actually more topical and relevant for most of you. I will address it by briefly talking about why did I choose the topic, so why EU taxation and tax avoidance. Then a few slides on the difference between tax planning and tax avoidance, to start to see some distinctions, and actually that is where I will try to make it interactive and make some decisions together with you. And then depending on how the time is going, I can tell you a little bit about the EU legislation in making this ATAT directive, which was already mentioned earlier by a colleague from the Netherlands. I'm indeed representing the Slovak ministry in the process of making this new piece of legislation in the European Council. We will see what happens with this document or this source of law, because currently it's the Netherlands presidency which is actually presiding these meetings. If they manage to find a consensus, we can have it adopted probably during the Dutch presidency. If not, it will move into the Slovak presidency, and I should be the guy who should be actually chairing this topic. So first of all, why EU taxation and tax avoidance? Because I think we have seen a lot of discussion in the media in the last few weeks when the Panama Papers have brought in things into our attention. We hear the slogans, taxes are for poor people. Why do they say that? Why there's this slogan that taxes are for poor people? Yeah, it's very difficult for ordinary people to exploit these type of structures. Although we see change behavior, we see the poor people seeing what is actually happening, and they see, why not me? Why cannot I have my offshore company? And so actually we see a trend, and actually it's because it's not so expensive to get an offshore company, that also the middle and small businesses, they start to use similar types of structures because they become increasingly accessible. And as they are getting increasingly accessible, you know, $500, $1,000 to register a company, we see the tax avoidance or even tax evasion spreading almost like a trend around the world. So the reason why I chose this topic also because I thought of a better slogan, and that is taxes are for judges. Because you are one of the few people who are not very mobile in terms of your professions. You are somehow linked to your tax system, and you are some of the few people who probably will very hardly avoid paying taxes. So sorry for the joke, but let us move a little bit further into the topic. So what we see in the EU taxation debate, over the last, let's say, decade, there was a lot of talk about the taxpayers' rights and actually the use of the fundamental freedoms for the benefit of the taxpayer. And actually, I think that that is the very important phenomenon or fundamental element of EU. The fundamental freedoms are there for the business to exploit it, to make it a functioning common market, to avoid the obstacles between the different tax systems, which can be an obstacle to making a business in different countries. So on one hand, we have these fundamental rights and freedoms, but what we also know, anything that can be used for good can be also abused. And I have spent part of my career in consulting, and I have seen actually that these fundamental freedoms, but also the EU legislation, some of which was discussed during the last years, or even last hours and days, is actually being also often used and abused for tax planning purposes. We introduced different directives, for example, directive on the dividends taxation, the parent subsidiary directive. This morning it was mentioned this directive has undergone a change. There was a special anti-avoidance measure put into the directive to stop some of the abusive structures. There's another directive which has been introduced. It is called interest royalty directive. That directive has similar intention, although different from the parent subsidiary. It was not mentioned. So just very briefly, the parent subsidiary directive is about non-taxation of dividends between two companies within the EU if certain conditions are met. So no taxation at source, no taxation in a country of residence, because it is assumed there is taxation taking place at the level of the operating company, let's say 25% in some of the countries. And it's also assumed that the final dividend will be taxed in the hands of the shareholders who will be residing in the EU. So we may expect another level of 15 to 30% tax at this level. This additional layer of taxation could create economic double taxation, which could be prohibitive for the money flows and corporate structures in the EU, which is true. But equally, we can use this instrument to bring in profits from outside of EU, from the offshore jurisdiction. So we can put a Cayman company at the bottom, which will somehow manage to receive diverted profits from the EU. There will be no tax paid in the Cayman Islands. There will be no dividend tax paid in Cayman Islands. Dividends paid into EU in many countries will benefit from a special participation exemption. So many countries will say dividends received, zero taxation, and then the money keeps on moving through the parent subsidiary directive measures. So no withholding tax, no taxation in another country. And actually, if this is Slovakia, Slovakia doesn't tax dividends even in the hands of individuals. So if it is the very Slovak profits which have been diverted into offshore, they can come easily back to Slovakia without any taxation. That's one of the ways how we can actually use and abuse the tools of the European taxation. The other directive I mentioned is the interest royalty directive. That directive has somewhat different effect. It also applies between the two companies in the EU, but to the payments in the form of interest or royalty. It doesn't lead to the double non-taxation, as you could see with the dividends. It leads to the loss of the taxation rights to the country of source. So source is not able to levy withholding tax. The residence country can still levy the tax. But what we see increasingly is the rise of a phenomenon or special tax regime called patent box or innovation box in the EU. It's a special company regime which allows, instead of applying the usual, let's say 20% tax rate, using a lower effective tax rate as a result of special exemptions, which can lead to effective tax rate to 2.5% in Cyprus, 5% in the Netherlands, in Hungary as well, 10% in the UK and other countries. So we see special regimes put in place, benefiting from special measures as a result of this interest royalty directive, because the country of source, where these payments will be deductible payments, dividends are not deductible, it's after-tax profits. These type of payments are coming against the tax base of a member state, so there is a reduction, which could be normally taxed, let's say, between around those 25%, but instead of 25, there will be nothing paid. Profits are shifted to another country, no withholding tax, and then maybe just the effective tax rate of 2.5% will apply. Who wouldn't like to benefit from such measures and companies? So we see a lot of the good ideas being actually tweaked and used for the benefit of taxpayer, and many times you would see the structures which not often have full economic substance behind them. It's easy to move intangibles into such regimes. The EU and OECD countries have been discussing the legacy and legitimacy of that type of regime, so they introduce a new concept, modified nexus approach for the patent boxes, which basically means this is okay as long as the research and development actually happens in this country, as long as it's not just artificial shifting of the results of the intangible activities. So there is a little bit of the feel where we are today. Now the very difficult and important question for you as judges would be, what is the distinction between using these fundamental rights or instruments and abusing them? What underlines a little bit the whole atmosphere in the society is the growing attention to the tax avoidance. We see that there is a lot of things happening in the media, both on the national, regional, but also global level. At a global level, we have seen the G20 and OECD project, so-called BEPS project, which is aimed to change the global international tax rules. At the regional level, we see this initiative of the EU to implement this BEPS project and actually introduction of the 8-step package, anti-tax avoidance package at the EU level, as a part of the combination of hard law legislation and soft law recommendations. And of course, we see a lot of different actions and reactions at the level of the national states. Each country does something else in its domestic law. But what is basically happening to us, the global efforts of the OECD is dribbling down to the EU level, and of course what will be agreed at the EU level will have to become the national law as well. A few words on the tax planning and tax avoidance, because these two behaviors are sometimes melted into one, and it can be all seen as good or all seen as bad. It's very difficult to look for the borderline, and again, guess whose job it's going to be? It's going to be your job, okay? So let us do a little bit of training on this today. And actually I would add on the third type of behavior, tax evasion, into the slide. All these types of behavior lead in one direction, and the direction is the reduction of the tax burden. We have to, and we know that the taxation is the only sustainable source of the revenue of the governments and the states. If there is not a tax revenue, the country is facing deficits, it can face defaults, it can face something that many countries are experiencing today. On the other hand, taxes are a cost for business. So companies have to pay tax, as well as individuals. For companies which are aimed to make a profit, tax is one of the few costs that doesn't generate actual profit. There is no direct link between the amount of tax I pay and what is the benefits I receive from the particular country's infrastructure. So there is this natural tension and conflict. The interest of the state, interest of the company or business. And the companies behave or react in three types of behavior: tax planning, tax avoidance, and tax evasion. Let us look in each of them a bit more closely. So tax planning, in my view, tax planning is very complex and multidisciplinary exercise. It requires the knowledge and the tax consequences of transactions, but in different perspectives. The commercial implications of behavior, the financial implications, accounting, legal, and also finally the tax saving that is the outcome of the behavior. In other words, it requires really to look into the future and think what and how will my business evolve in 5 or 10 years from now, and what I want to do now to make sure that the structure I put in place is there to lead to a lower tax burden. Oftentimes we see even governments giving us incentives to do tax planning. How do they do it? They give us special tax incentives or even tax holidays. They say, if you open a company in this special economic zone, you'll pay no tax for the next 5 or 10 years. What is the objective? They want you to behave rationally, and if they give you a no taxation for a certain period of years, in exchange for you to move into that location, create employment, create commercial activities, and help to develop that region, that is the benefit for the government. So actually we many times see that governments count on the tax planning behavior of the taxpayers and then incentivize them in different ways. The second category of behavior, the tax avoidance, is a bit more tricky. I would say that rather than substantive structuring of a business, so putting real economic substance into the location, it is more about exploiting of different rules, rights, and benefits in the legal system, but from the formalistic point of view. Yes, company is opened, but it's empty. There is nobody in that company. There are hardly any employees, or the level of employees doesn't match the level of activities as presented by the company. The profits booked into the company have nothing to do with the actual activities of that company in that particular location. So compared to the tax planning, we see tax planning, I would say, substance and the legal form, they are matching. It's like legal and economic, there's like a match. It clicks together. To me, tax avoidance is that the legal and economic are mismatching. There is maybe a little bit of overlap or no overlap at all. They are two completely different things. So we see the abuse of the domestic law provisions. Those same incentives intended to attract businesses to a special location in the country can be abused by the companies. And they have done it for decades. They will put a company into the special economic zone, but employ very few people in that location while carrying most of its operation in the other part of the country, but then transferring the ready products, the ownership to them, to this entity which will do the packaging and shipping it out. Most profits booked in that entity. There will be example where we have the mismatch between the expected behavior of the taxpayer from the side of the governments. We wanted you to create jobs and employment here. You employed a few old ladies to wrap up something which was being done in the other part of the country. The governments can do better job drafting the laws and making the conditions clear. But that is exactly where the taxpayers can come in. If the laws are not drafted well, they are exploiting them, and exploiting them in a way of taking advantage of the legal form and oftentimes leaving the substance somewhere behind. So this behavior is already considered to be uninvited and unwelcome behavior of taxpayers from the perspective of tax authorities, and they are often challenging this behavior by special or general anti-avoidance rules and provisions. So the ATAD directive, the provisions that were mentioned earlier this morning, they are exactly about the rules aimed at specific types of behavior which could be considered tax avoidance. The last and final category is tax evasion. To me, the meaning of tax evasion is knowingly ignoring the tax liability. It is basically the failure to file and pay the tax. So to file the tax returns, declare it, and actually pay the tax, which is due. It often happens through hiding or non-declaring of income. So the secret bank accounts in Switzerland, Liechtenstein, and elsewhere in other offshore companies, that is exactly the type of behavior. I have income, I pretend I don't have it. If I actually own the bank account and I don't mention it in my income declaration, the interest I earned or money I earned to that account, I'm actually committing tax evasion. We see some dramatic developments around the globe in the last years. There was a big case, the UBS case, which had the Swiss link. It was about the US nationals opening bank accounts in Switzerland and having secret bank accounts. So actually earning money abroad and interest on this money, but not declaring it into the United States. So the next case, which was right into the heart of Europe, Liechtenstein case, similar story. It was German wealthy people, even politicians or top business leaders, having their secret accounts in Liechtenstein. Interesting case was in the United States, the KPMG case. Not very people know about that case. That was a case which has shaken the company. It could have led to the similar situation like Arthur Andersen. The US government was threatening with criminal prosecution of this company. What has happened in that case, the tax people in the company were offering special paper losses to the wealthy individuals. So the wealthy person paying the marginal tax of 35% in the United States could actually reduce its tax base, or his tax base, by coming to the company, and they would sell him some sort of a product which was a derivative instrument transactions or series of them, which led to a loss, but only on the paper. He didn't lose the money, but on the paper he had a loss that he could offset against his profits or income, which could lead to a lower tax burden. This became so widely spread product that actually many wealthy individuals, suddenly their tax paid started to reduce quickly, and the tax inspectors got suspicious, started to investigate, and they found out it was actually a company very actively selling this type of product to its customers. The company, to avoid a criminal prosecution, they actually gave up their employees. They would say, these are the 50 tax partners, please take them to jail, they are responsible, so the company can survive the day. So what we see, these cases have really brought a lot of attention to the evasion problem, which is basically having the income, not declaring it, not paying the tax. We see more attention now shifting to the tax avoidance cases. Most of the cases that I have mentioned even today, they are linked to a certain extent to the tax avoidance behavior. Now, I promise you a little bit of interactive time, so this is it. We will look at a few cases together and think whether the case represents to what you would say is legitimate and acceptable tax planning, or whether it is acceptable, or whether it is tax avoidance. Okay, these two types of behaviors. So the first case involves an individual taxpayer who owns company A. So original scheme is that company A is a holding company that a person owns. Company A owns company C. So there is some sort of a holding structure in place. The law, however, is not very friendly in this situation, because when he suddenly has somebody who wants to buy company C from him, the tax law would basically trigger two taxable events. When the shares will be sold to the new buyer, to the purchaser, there will be capital gain taxation at the level of company A. At the same time, to get the money out of the company, there will be additional layer of taxation, the dividend taxation. So the same profit of, let's say, 100 will get taxed two times. Once 30% when the capital gain takes place, Second time, the 30% when a dividend is paid to the individual. So actually quite a high tax burden. What the tax advisors come up with is a suggestion, well, or explanation. If you do nothing, double taxation, we have an idea for you. We can take advantage of the intra-group reorganization rules. So the legal system allows the following. We create a new company B. So you'll be now shareholder of A and B. Both companies are fully owned by you. We will transfer the shares of C from A to B. So now B owns C. In the next step, we liquidate company B, so it disappears, and you become the direct shareholder of company C. This is fully tax-free. It's tax neutral because there are domestic rules which allow these group reorganizations tax-free. Then you make the sale, you sell company C shares. Okay? And you skip one layer of taxation. So that is the first case. And I would like you to give your feeling about a case. I know that in a real case you would have not 2 minutes, but 2 days, 2 months, or even 2 years to think about it. Today I give you, very short time, but based on your impression, and it's not only feeling, I actually can see what has been happening, what is the sequence of the facts. Would you say this is a legitimate and acceptable tax planning behavior, and taxpayers' rights should be accepted and tolerated? Or you would say, no, this is actually unacceptable tax avoidance, and it should not be allowed. Okay? So let's go for the first one. Who says it's tax planning, and we are fine with this? Okay, so there is quite a group. Thank you very much. That was excellent. Who says this is tax avoidance? I'm against this. 1, 2, 3. So majority said this was actually okay. Well, I intentionally picked a case which was already decided. This case is the Gregory versus Halvorin case from the United States. Okay, it is from 1934. Decided basically at the top level in the Supreme Court, where the Supreme Court judges, to the contrary with the lower level judges, said this was not okay. This is intentional abuse of the rules which are not intended for this purpose. And they formulated 3 doctrines in the same case. The business purpose doctrine, substance over form doctrine, and the step transaction doctrine. Until then, this was okay behavior in the United States as well. That's why the previous courts would let it go, until the Supreme Court said, well, this is not entirely okay, and this is not a behavior we want to be encouraging, and taxpayers exploiting these benefits or rules or rights which were actually intended for completely different purpose. Okay? If we have more time, I would go in the details of the doctrines, but that became the case law for the United States. Since then on, such behavior of taxpayers was basically hitting the wall. Let us try another case. In this country, there was a special surcharge for wealthy people. The country, like today, needed money, revenues. Where to take the money from? We know the taxes are for the poor people and the judges. But the poor people don't have enough money to pay the tax. If you really need a lot of money, you have to take it from the wealthy people. So a special surcharge on wealthy people. What you tax is actually their income, their annual income they earn, by extra layer of a high tax. The special design in the law said you cannot deduct expenses. Any expenses you have, they are non-deductible with the exception of expenses which are like annuity. You have to pay it. Okay? So this particular taxpayer had a lot of employees. So he had a lot of costs incurred. Instead of continuing paying them their salaries, he thought, if I pay these people annuities rather than salaries, I don't have to pay the tax. I can make deduction of these expenses. So what he did, he basically revoked their employment contracts and issued them a deed, like annuity deed. So you guys will be doing the same job, like every day, cutting the grass, opening the door, but I'm paying you an annuity. Okay? All right. Everybody was happy, with the exception of the tax administration. They thought, well, wait, what happened here? You were supposed to pay the tax. Now we don't pay it because you changed the form of the relationship you have with the employees. you now give them annuity. That is unacceptable. We will disregard this legal form. We will still make the tax assessment based on the substance. These are your employees. These are non-deductible payments. Okay? So who would say this was okay and this was acceptable tax planning? Please raise your hand. Nobody. Who says it was aggressive tax avoidance behavior? Okay, so majority of you this time. Well, this case was also decided, and some of you have recognized it. That's the Duke of Westminster case. And it was actually ruled in favor of the taxpayer, okay, in 1936. What was it? It also brought some famous quotes into the tax literature and future case law of the UK for the next several decades. So the argument of taxatory was basically ignore the legal form, focus on the economic substance. Lord Tomlin, which was one of the writing the opinion, actually said, if he would do this, this would mean that the gold and straight cord of law would be replaced by twisted wire of considerations. Every man has a freedom, if he can, to arrange his affairs so that the tax assessed in accordance with valid laws was as low as possible. And the Lord Russell has added, taxpayer does not have to pay the tax as a consequence of intention or analogy of law, but only in accordance with the consequence of the words of the law, which is applied to the facts and circumstances of the case. If the state, the Crown, which is trying to collect the tax, is not in the position to fit in the taxpayer into the letter of the law, the taxpayer is free. However, against the spirit of the law, this approach can seem. So in other words, that was perfectly okay. So we have two completely different decisions. Also, you have been having different views on the two cases. What is interesting about these two cases, they are more than 85 years old by now. Okay? So they are from the 1930s, from two different countries, but something similar is in question. To what extent it is acceptable to take advantage of the legal form versus the legal substance of the transactions. Different decisions of the judges, two different continents, but very similar fact pattern. Let's do case number 3. These was actually quite domestic cases, as you realize, but I use them just to give a flavor of where is the tax planning and tax avoidance. This one brings us into a cross-border situation and closer to the EU subject today. In this case, we have a state-owned company. So many countries still own shares of companies. Greece is one of them, as I know, and there is a lot of privatization coming up. Very similar case, this one actually from Slovakia. So the state is privatizing a large company where the two strategic investors are two foreign shareholders. Each owns less than 25%. So each of them actually owns 24 something. Why you do buy companies, there are many different reasons for purchasing company shares, but one of them is that you expect future profits. And when you get the profit out of the company, there is usually a withholding tax. The withholding tax is basically like the second layer. So we have the first layer, the corporate tax, again the 25%, and then there could be a second layer tax on the profit distribution, the dividends. That was exactly the case here. So the state would, under normal circumstances, be entitled to levy 25% withholding tax. There are tax treaties in place. Now we have also the EU legislation, the parent subsidiary. This case was just before Slovakia has joined the EU. So the EU law was still not yet fully in force or applicable to Slovakia. So the only thing there for the investors was to take advantage of the existing tax treaties. Actually, I will show it better on the next slide. So this was the scheme. The government still remained at 51% shareholder. The two shareholders, each owning 24.5%. They realized if we keep the structure like this, we end up paying one of them 15% withholding tax to one of the countries. The other one would be actually 10%. There will be a slight reduction of the withholding tax from 15 to 10. So they could get a little bit of better deal. They consulted with the tax lawyers, and the tax lawyers say, well, boys, you could be a bit smarter. You can put something in place like a holding company in the Netherlands. Because Slovakia has a tax treaty with the Netherlands, which provides to shareholders who own more than 25%, zero withholding tax. Okay, so you can get this 15 and 10 down to 0. All you need to do is to put a holding company in place. So basically the steps of the transaction would be the two shareholders incorporate a new legal entity in the Netherlands. The shares they have, they put as a capital contribution. So now this company becomes a shareholder who owns 49%. Each of them before would be only 24.5, now it's 49. So meet the conditions in a treaty, it's more than 25%, zero withholding tax. All happened in a matter of weeks. The next step was the declaration of dividend. It was actually a multi-million-dollar amount. Dividend was paid to the Dutch company. Now that's where something interesting happened. The company would not just pay on the dividend immediately. They would say, wait a minute, let us put the money on a bank account for a month. Okay, the time was running, month is almost over. Let's do the next thing now. Instead of paying dividend, we pay each of them, we give them a loan. Each shareholder now received a loan for another half year, which actually was earning interest or paying interest. So a little bit of interest was accrued to the Dutch company. The time was running. Half a year later, say, all right, now I'm declaring a dividend. And I'm not paying you anything because you already have it. Okay? So you don't have to pay me the interest. You don't have to pay me back the loan. Actually, I'm declaring a dividend. We are offsetting these two amounts. Okay? So that is basically the facts. Now, the question to you would be, tax planning or tax avoidance? Let's make a bit of a show of hands. So tax planning, acceptable. We are happy with this. Okay. Tax avoidance, not acceptable. Okay, very interesting. Show of hands. Well, we had this case coming up to the Supreme Court 2 times in Slovakia. And 2 times the Supreme Court was not very happy to make a clear decision. It basically said 2 times, explain me what is this OECD model convention. The second time it said, well, what is interesting, the tax authorities try to argue with the beneficial ownership concept. That's a concept we don't have time to explain today, but it is in the tax treaties, and it can be like a limitation or preventing some abuse. This was an old tax treaty from 1970s. The concept of beneficial ownership was not even thought about, because at the time there was so little of such abuse happening that nobody thought about such a provision to write it into the treaty. So technically, it was not in the tax treaty. The tax treaty said, well, that this company is not a beneficial owner. These are these 2 shareholders who are entitled for the potential treaty benefits, but they are in the 2 different jurisdictions. So they argued this is not a beneficial owner, it's not entitled for the treaty benefits, and they claimed basically the full 15% withholding tax. So the two times the case went down to the tax authority, it's still back into the process. The tax authority has to still come up with their kind of new assessment or work it out. Okay? So that's something, that was a Slovak perspective. How much time do we have now? 0. So I had some more questions to discuss with you, some more examples that we can perhaps do next time. And of course, I was going to talk about the changing of the rules at a global level. I was going to tell you a bit more about the BEPS project and about this EU anti-tax avoidance package, but perhaps next time, okay? Yes, so thank you very much.